Happy Friday, everyone. Jason Jacobi here with your closing bell. Really excited to deliver you this content for this week. It was a heck of a week in the markets. We are up across the board here for the major indexes. 1.75% for the Dow. S&P was up about 1.9%. NASDAQ was up about 2.58%, and the Russell 2000 was up about 2%. So a great week for the markets. February, we had a down month for the markets. Again, I just want to give a quick recap. Got to know where we've been to know where we're going, right? So Dow Jones led the way at 4.2% down for the month of February. The S&P and NASDAQ declined 2.6 and 1.1% respectively. But here's the conundrum. So here's what I want to talk about in this video, right? You can read a little bit more about each individual topic below in the newsletter. But the main things I want to touch on is there's a lot of contractionary or recessionary types of indicators happening in the market, from inverted yield curves to durable goods orders to personal consumption expenditures coming in a little bit stickier and a little bit hotter than we expected. And then manufacturing slowing down, mortgage demand drops to a 28-year low. These are all topics that I cover in detail below in the newsletter. But what I really want to talk about is the kind of conundrum that's playing out in the economy. So here's what the Fed's thinking, or at least what I think they're thinking, and here's what we're going to do about it. So the Fed's looking at and looking for cracks in the economy, right? And again, like I said, we are already showing some signs of slowing down in specific areas of the economy. Well, the most stubborn part of the economy to date is the labor market. And if you saw our social channels today, I talked about the labor participation rate being at some of the lowest levels in a long time, which I'll get into in a second. But we have a tight labor market. So with low unemployment, again, over 50-year low in unemployment, 3.4%, which sounds good, right? A lot of economists and researchers, analysts are cheering for that. I'm not going to hammer on that. That's not what I'm trying to do in this. But it's more to shed light on there's a number that we should be more concerned about, and that the Fed's going to be looking at too, both near term and long term. Okay, that's the labor participation rate. So from age groups between 20 and 24-year-old males, okay, they have left the workforce in large numbers. So 2000 was the height of the participation rate for that age bracket. Since the year 2000, we've lost over 10% of that age group's workforce. Where did they go? I don't know. You're also seeing help signs, help wanted signs in windows now. You're wondering, I thought we have unemployment rate. There's a lot of jobs out there. What's going on? Well, a lot of people aren't getting back to work. I mean, whether it's moving home with their parents to being able to save money, or the pandemic, they just haven't kind of gone back to their traditional day jobs, or they're taking a little bit of welfare money and working barely the minimum they have to, whatever it may be. This spells near and long-term problems for the economy and for the individuals, right? You want the individual to get the experience and education to really grow and thrive in a capitalist society like we have. But at the same time, it's troubling long-term, because we're 10, 20, 30 years down the road when these young people who haven't gone back to work, they don't have any experience or education in those fields that they could have been in for the past decade or two. That could spell trouble for a specific industry or for the economy as a whole, right? Because again, you're going to have incompetent people trying for jobs or getting hired for things that they're not qualified for, because we need workers. That's just the story here. Again, this is just numbers speaking. I'm not bashing on anybody specifically, but that's something that we're watching. And the Fed is looking at the unemployment rate right now, and labor costs and how tight the job market is, and saying, whoa, we're nowhere near done raising rates. So that's the conundrum I'm feeling. It's like the good news is bad news thing we've been talking about for a while. But it's really interesting to see, we don't have the labor participation rate that we used to have, but yet we have record 50-year low of unemployment. And yet the Fed's going to continue to raise rates because how strong of a labor market we have, how many people we have working, and again, the wage growth. It's interesting. So it shows that we have a ways to go with inflation as well, because as we talked about last week, the personal consumption expenditure report measures inflation on a year-over-year basis, a month-over-month basis. It stayed flat from that previous reading. So that's just showing things are a little bit stickier than we thought. And then in turn, when the Fed says or sees numbers like that just came out this past week, of weak unemployment, then they're going to say, guys, looks like we're not going to have those rate cuts this year. We're going to continue to have high rates, which they've been saying for a while, for quite some time. The markets will react because the markets are forward-looking. Again, we've talked about this before, and which is going to bring near-term volatility. So I think that's the thing I want to touch on is there's a lot of bad news in the economy, which again is good news for the Fed to stop raising rates, but the things that are kind of being stickier with the inflation piece, certain sectors haven't been washed out yet with the inflation, and the strong labor market, that's only going to cause more headaches, and hopefully nothing serious breaks in the economy because of the continued rate hikes. That's something that we need to watch out for. And again, I'm not trying to be doom and gloom. I think if we can kind of get through a slight recessionary period, or the labor market starts to soften here in the next few months, then we could have a great second half of the year, or at least fourth quarter of the year for the markets again. Because once things become certain, the Fed says, okay, we're going to pause, and then we're going to start cutting rates. We think by this date, the markets, specifically the tech sector, those growth stocks that have been hurt so bad this past year, will rally and rebound, in my opinion. So in all honesty, my thing with this is, hey, we're going to wait and see approach. Nobody knows what's going to happen in the near term. We can't control the labor numbers. We can't control the Fed. We can't control any of that. We need to stick to our game plans. We need to stick to our investment strategies. And then give us a call if you have any questions or see how this affects your portfolios. Again, this is what we do on a day-to-day basis. Not concerned overall, but I do think that overall the Fed's target inflation rate of 2%, they think is attainable. I don't think it's attainable in the near term. I think if you look at the last 90 years-ish, dating back to around 1931, again, not specifically talking about that date, but 1931, I believe, if you measured inflation back to that point, year over year, it would be about 3.9%. So that's some food for thought. If we can get down into the threes, I think that's a win. We can all live with a little bit higher inflation in the meantime for quite some time because it's a heck of a lot lower than what we've all been paying, right? But anyways, if you again have any questions, give me a call. I know this is a little bit longer commentary, but it's just some things I wanted to kind of touch on this week. Again, always here for you. Give me a call if you have any questions. All right, we'll see you next week.